Welcome to the Better Together podcast, where we look for ways we can work together to advance the gospel of Jesus Christ. Today we have with us Mr. John Brummitt. He is the CEO of Richland Avenue Financial, formerly known as the Free Will Baptist Board of Retirement, and he's here to talk to us about some financial matters that are really interesting and helpful to all of us. So, John, first of all, thank you for taking the time to be with us today.
Thanks for having me on. Happy to do it. Happy to talk about finances and helping people get back on track from, mistakes that they made in the past or not getting started early enough.
This is great. And so I think I reached out to you. I know you get the Wall Street Journal, and I read it as well. And so there was an article that came out maybe 5-6 weeks ago. It says, as Generation X approaches retirement, reality still bites. And reading that and looking at that, I realized, oh boy, we have a whole generation. So they're talking about, we think about baby boomers, we think about millennials, and really what's in this material is something that's helpful to everybody. But
Right.
Tell us why it was especially bad for Generation X, why they're especially going through some difficulties with retirement.
Yeah, so the reason that Gen X is in such a unique situation was boomers came in before Gen X, and in the boomer generations and the greatest generations before, you had what was called a defined benefit plan, which was a traditional pension plan. Those pension plans, your employer took care of everything. You basically showed up to work, you started on your first day, you worked most of your career, if not all of your career, at that one employer. Then whenever you left that employment, they continued to pay you based on your years of service and what your final salary was, and it was a ratio. And those were very beneficial for the people who were working, but it was also helpful for the employers to be able to retain those employees. The problem with that is the continuation of that program becomes a financial burden on the companies to be able to maintain it. And if the company's not growing and continuing to be profitable, then that becomes a pretty big lag. You can look at like GM and Ford and companies like that, to where they have these defined pension plans that are really hindering them in their profitability now. Most of the places that still run those type of programs are governments, things like that, to where they can kind of dictate how much money they're bringing in to be able to fund it and all that kind of stuff. And so they can kind of hedge their bets against what is basically coming into the coffers to be able to replenish that. The Generation X was the first generation where we started to transition out of that defined benefit into a defined contribution. And so it was a test. They were trying to see if they could do it. It took the liability off of the company to manage everything, but it then put that liability back onto the individual. The problem is the individuals weren't trained in it. They didn't know anything. They pitched it as, well, you have control. You can do all this stuff yourself, but they didn't tell them that, well, now you're responsible for it, and so if you don't do it right, then you're in trouble. And a lot of it has changed over the years, but that first leading edge of the Generation X was the test subjects. And so they've refined it some now so that millennials and even Generation Z are seeing a better formulated system. But Gen X was really like that cutting edge, where it was like they ended up being the bleeding edge instead of how it was all put together.
So because they were kind of the first, it wasn't as clearly defined, and a lot of mistakes were made. The recession happened in 2008, 2009, and that's where a lot of them really lost their money.
Yeah, a lot of the issues that came was there wasn't a lot of education out for it. And so it was like you were just told, this is what you have now. You have 401ks and 403bs. Those are your avenues to put away for retirement. But they didn't say, well, you really need to put this much away, or it's a good idea to have this much, or you need to automatically enroll or escalate each year, increasing your stuff. All that stuff has come later in the 90s is when it kind of pitched in. But it wasn't there when they started. And so they were lagging behind in the first place. But then once you started getting into like '02 when the dot-com bubble burst, and then the housing market burst in '08, '09, those were like major things that before, when you had a traditional pension plan, you didn't see that. Like you saw the economy go up and down, but you didn't see now you have a piece of paper that shows your balance, then now it's just went straight down. And so that caused a lot of fear, and a lot of people would pull out. The housing market was a double whammy for a lot of reasons, because a lot of people had houses. Their two main assets were their house and then retirement funds. And they were underwater in their houses where they owed more on their house than what it was worth now. And so they would dump it or they would sell it. But then they'd have to draw money out of their retirement to be able to pay for their living expenses and things like that. And so it ended up taking away both of their assets and then put them in a much tougher position to try to regain when the economy came back, in which the economy did come back and it regained after that. But them being able to sit and maintain through that, they just didn't have that option.
And so we're listening, and maybe you're not part of Generation X. You could be a Generation Zer or millennial, or you're thinking, what can we learn from this? Real quickly, we learned when they sold, they truly lost.
Yeah. So when you're looking at your statement now, you'll see ups and downs. You'll have good years, you'll have bad years, you'll have good quarters, bad quarters, and stuff. But that volatility that's in there is actually very useful, because that volatility is what gives you your gains. You have to suffer a loss in order to buy in at a lower price to be able to get the gains later on. And so people who bought at the bottom of '08, '09, by the time you got to 11 or 12, then you saw like 180% return on your investment if you bought in at the bottom. But people that sold and then didn't buy back in, then they lost that. And so it's all in being consistent and not panicking, just being calm and letting it do its thing. With your traditional pension plans, you had professional money managers and things like that knew how the market worked and stuff, and so they didn't get ruffled when that stuff happened. But whenever you put the onus back on the individual to do, then they have to have a level of expertise in it to not get ruffled as well, in order to maintain their balance as they're going through their career and cycles of the economy and stuff.
So I start participating in a 401k, and I'm putting money aside, and I see my statement come back, and it's $20,000, $40,000, and it builds up. And the idea is that it builds and builds and builds, and it's earning a return. But all of a sudden, it was at $80,000, and now it's at $65,000. That's where people sometimes, oh no, got to get out.
And that panic is real. Like the markets work adversely to what common nature is and stuff. So like most of the time when you start feeling pain or something, you back off from whatever you're doing. Like if you're burning your hand, you'll take your hand away. The markets are the reverse of that. It's like an upside down type thing, to where it's when it starts to hurt a little bit, that's when you should put more money in, because that's when you're buying it at a cheaper price and it's going to come back up and stuff. And so you have to kind of go in with that mindset. The other issue that people run into is they don't look at it long term. They very much look at it on right now it's down, and they don't think about, well, I've still got another 20, 30 years before I get to retirement. It doesn't really matter what it's doing right now, because I'm looking at that long-term picture. If you look at any market returns or anything like that over a 10-year period, they're all positive. If you look on a 1 year, they could be positive or negative, but the longer your timeline is, the more that it just always skews positive. And so being able to look at your investments or your retirement fund in a long-term kind of scope allows you to kind of see that, oh no, when it's going down, then it's okay, it's going to come back and stuff. a lot of people will talk about, well, what if it doesn't come back? What if the economy collapses and all this kind of stuff? And I always tell them that, well, if that's the case, if it's the government's collapsing and the dollar's worth nothing, you got bigger problems than what your account balance is worth at that point in time. So you really don't have to worry so much about that. But it is one of those things that you kind of have to condition yourself on the front end of, I'm looking at this long term, not as what's it doing today.
So like with Richland Avenue Financial, you can go and check on a daily basis. You've got a dashboard and you can see where you're at.
Yeah, we've changed a lot of stuff on our system to be able to be more user friendly for our individuals to be able to pull it up on their phone and look at their account balance, and there's an app that you can download and all that kind of stuff. But it's good to be able to do that. It's probably not good for the just normal every day to be checking it.
Yeah.
Because you do kind of get into that sense of, I'm looking at it more as what it is today rather than what's it going to be in 10 years from now.
And so you also send out quarterly reports, which is probably a better thing. And you can always look at the bottom and see, okay, I can see the trend. If you've done it over years, you can see the ups and downs. And so what you're saying is, if you're an anxious person, maybe you don't check it every day.
Yeah. So most people, the younger you are, the less you really need to check. You need to check your quarterly statement to make sure that your contributions that you're making are actually getting there. Nobody's perfect. If your payroll department has just forgot to send it in, or if a check got lost in the mail or something like that, it's always good to go back and check. It's much easier for us to figure out what happened in a 3-month span than it is a 30-year span. So if you come up 30 years and it's like, oh, I should have had this much in my account, and we're like, we just get what comes in. We don't know, because we don't work with the payroll of your church. We just receive it and have it in. And that's true of most retirement plans, is they're probably not the ones doing your actual payroll. And so making sure you're checking your account statements at least once a quarter to make sure that your contributions are being put in and they're being invested the way that you want them to be invested is the biggest reason to check those statements. It's nice to look at your account balance growing and stuff, but the biggest thing is to check to make sure that what you had thought was happening actually was happening.
And so we've got a lot of pastors, a lot of people in ministry listening. We're living in a parsonage now. They need to go buy a house, or they've got a kid that needs to go off to college. Is it a good idea to take money out of your retirement to pay for a house or pay off debt? What's that going to look like down the road?
Yeah, so that's a pretty open-ended question, and it depends on the individual themselves. So it might be a great idea for you to take money out of your retirement account and buy a house, or pay for school for your kids or something like that. But if it's your only resource is the retirement account and you're going to need that to live on, then I would probably look at a different place of pulling assets from. Because while you're working, it's easier for you to make money than it is once you get into retirement years. It's much harder to find employment. It's much harder to kind of dictate how long you're going to work, because you could have health issues and things like that. And so accumulating your assets while you're younger and working is more advantageous than trying to pull money from here and not have it once you get into retirement years.
And if you start over, as many of Generation Xers did, it's so much more difficult to start saving at 40 as opposed to 25, isn't it?
Yeah, and the problem with the 401ks, and it's still a problem today, even if you're in Gen Z, is that if you leave employment with a company, then you can draw out of your 401k. It's a distributable event for you once you've severed employment. A lot of times what will happen is they will take that money and use it for just everyday stuff that's happening. Living expenses, or if they had a home repair or something like that, they'll pull the money out. Well, then they've started and stopped several times in their career because they've changed jobs. Whereas with the pensioners, whenever they had their defined, they would stay with the same company for a long time, so they would never pull out of it. But in today's society, I think right now it's common for you to change jobs somewhere between 4 and 6 times in your working career is about how many times you'll change jobs. And so if you're restarting every time, then you're just extending out when your actual start date for retirement was. Mm-hmm. And so, if you started at 20, but you pulled it out at 30, then you started at 30. And if you started at 30 and pulled it out at 40, then you started at 40. And so I think right now the average is around 51 is when most people get serious about saving for retirement. Mm-hmm. That's a lot of people in the U.S. that's when they start, is in their 50s. And that only gives them about 15 years to accumulate assets to be able to live on for the next 30. And so that's not really enough time without them putting a massive portion of their paycheck each month into their retirement accounts.
Because to get a good return, they've got to have a decent nest egg. 7% return on $20,000 is not what it would be on 40 or 60 or 80.
And another issue that we're facing now that we weren't facing before is life expectancy is extended out, but also adolescence has extended out. So used to probably even with Gen Xers, you probably left your home when you're about 17, 18 years old and you didn't come back. Like you were out on your own, you were gone. But your grandparents were probably still on their own too, like they weren't coming back. Now, Gen Xers are in that sandwich generation to where they have boomer parents or greatest generation parents who are needing cared for, and so they're coming to live with the Gen Xers. But they also have children who are leaving the nest and then coming back, and so they have two sets of generations that they're responsible for financially. And so that puts a strain on how much they can save and how much they can put aside for that. And so we did a podcast on the Reinvest podcast a couple of weeks ago that talked about that sandwich generation and how the culture has shifted to where that is more commonplace than it used to be. Used to, you'd raise your kids until they were about 18 and then they'd be out on their own. They would still come back for certain things, but you weren't financially supporting them like you are now. And you didn't have parents that were living as long, so you weren't taking care of both sets at the same time. And that's a pretty big financial burden to be able to do that and still try to take care of your financial needs as well. Mm.
So as I listen to you, I come away with a couple of lessons. One, start investing early. Mm-hmm. Do your best to leave it alone, even if you've got to send a kid off to college or parents come home, and to remember you're going to need something to live on. Mm-hmm. So even when kids come back to the home or parents come to the home, you're still trying to invest. You're still trying to do that. And I'm also hearing you really need to invest. It's not a CD or just putting money away in the bank.
Yeah. So one of the biggest things that Gen Xers have struggled with is because they went through the 2002 recession and the 2008 recession, which were both very heavily hit with stocks going down dramatically. Because of that, then they got very gun shy of stocks, and so they did more on, they wanted fixed income or some kind of guaranteed return. The problem is to be able to give a guarantee, that means you have to take some of the volatility off the table. And the volatility is where you actually make your returns. And so being more conservative in your approach means that you have to change one of the inputs, because when it comes to your investments, you only have a couple of ways to make money. You either have to save more or you have to have investment return help build it. And so if you're going to hinder the investment return by making it locked in at a more conservative rate, then that means you have to save more in order to make up the difference. And most people can't do that. And so being able to be in the markets and have the equities return for you is the easiest way for you to build assets. Average market return for equities is going to be somewhere between 8 and 10%, somewhere in there. And so that compounding will help you quite a bit grow your assets for retirement.
Probably the only way to beat inflation, isn't it?
Yes. Banks are going to stay close to inflation. The Fed really likes inflation to be around that 2% mark. I think right now we're still clicking along at 3%. So even if you're in a high yielding CD or money market account, then you might be keeping up with inflation. Some places will give you somewhere between 4 and 5 right now, so you might be a little bit better than inflation. But when you take in the cost of inflation on your dollars, you have to basically minus out that. So if you're getting 5 at a bank, but inflation's at 3, you're really only getting 2. And so you're not really making a whole lot on your money that way.
So just to recap, you're talking about going ahead, getting in early as far as investing. You're talking about investing, not just saving, and to put your money, park it. Don't let the ups and downs of the market distract you. Don't take money out for various things. A lot of people, though, are Generation X that are listening today, and they may be, well, that's nice if I were 25 or 35 or even 40. What can happen? What can be done for this point for those folks?
So the biggest things is, like I said, you've got 2 levers that you can pull. You can pull your savings, or you can pull how you have it invested. For the leading edge of Gen X, they are probably in the next 10 years going to be hitting that 60, 65 mark, getting into retirement. And so they don't have a lot of time left. Being super aggressive with your investments at that point may not be the best avenue for you to go, because while you have enough time for it to come up, you also are getting close enough to where you should be pulling some of that risk back off the table. Increasing your savings amount is probably the lever that most people would have to pull. That makes it difficult, like I said, if you're in that sandwich type situation to where you have older parents and stuff like that. But that is probably the most practical way of increasing what you have saved. The other thing that most people don't like to hear, but is probably most common as to what they do, is they extend out how long they're going to work. And so instead of retiring at age 62, then it might be 72. They'll extend it out so that they have more time to save, more working years to be able to put into that pool and let their assets grow.
So really, that's it. You've got to have more. You have to have more income, and if you do more, there are riskier, more aggressive ways of investing, but you can't come back like if you do that route. If there's something,
time is your biggest asset when it comes to saving for retirement and things like that. Time is one of those things where you're only given a finite amount, and so you can't make more of it. And so being able to work longer, and with our pastors, with pastors in general, not just Free Will Baptist pastors, but pastors in general, they really don't retire. They may retire like from being the lead pastor of a church or something like that, but they don't really retire from ministry. And so a lot of times they will go and be a supply pastor someplace, or they will help out at a church or something like that. And so they can derive income from that. And so maybe it's not enough to offset what they were getting, but with the retirement savings they had plus that income, it helps help them to get by and stuff like that. So pastors are in a unique situation to where your calling doesn't kind of end at a certain age. You're just kind of called to just keep going until the Lord tells you can stop. So.
Yeah, and that can be helpful too, because there is hopefully there is something still coming in that helps offset all of that.
Right.
Well, this has been a very interesting conversation, John, and it's not the most, even this Wall Street Journal article, it's pretty down,
It's not a positive. I wish I could go away with every conversation and be like, no, you're going to be fine. But there are consequences to our actions, And, like it or not, a lot of us weren't educated on what we should be doing or should do and stuff. And so being able to have conversations like this and talk about them, it might help somebody to be able to say, oh, no, I really need to get serious about this and, turn it into a positive situation for them.
And you're an older Generation Xer. You talk to your kids about how important it is to invest.
Yeah, I think Gen Z is probably the first generation that will see the importance of how the 401ks work and that kind of stuff, because the boomers are really the first generation that will be retiring on them. And so they will get to see kind of, oh, we should have done this or we should have done that. And then that education will start filtering in. And so, if you want to have a positive spin, then, the younger kids might have a better chance of making these things work.
This is good. And you're like, hey, what does this have to do with the Bible? All those proverbs about saving and preparing are all there. And you think about the parable of the talents. You've got whatever it is you've got.
Yeah, there's about 2,000 and some verses in the Bible that talk about finances or stewardship of some sort. So it's a very important subject that we're supposed to have mastered. But I think that our society has kind of downplayed it a little bit to where it's like, oh no, you don't need to know that, or if you're a Bible person, then you shouldn't even care about that. And it's like, no, it's a tool that you're supposed to know how to use.
Yeah, very good. Well, thank you for taking the time to be with us today. To track you down, Richland Avenue Financial, they could check out the Reinvest podcast, and they could always call the office or email you as well.
Yeah, we're happy to answer. Even if you're not a Free Will Baptist or not a pastor, then please give us a call. We're happy to chat with you about anything that you have to chat about.
All right. We want to thank you all for joining us today. I suspect you know someone that could benefit from this podcast. Take it and please share it with them. Remember, every little thing we do, it really does matter. We truly are better when we work together. Thank you for joining us today.